Reserve Bank of India, India's central bank, has released its new monetary policy. The repo rate has been cut by 25 basis points to 6.25%. Now, what does that mean for the citizens? Does it even affect them? First, let's look at the definition of repo rate. It is the interest rate at which an Indian commercial bank like State Bank of India, ICICI, etc. can borrow from the central bank. So if the repo rate goes up, the rate at which a bank can borrow from RBI goes up, thus reducing the amount of money borrowed by the banks. Now banks are borrowing at a high rate and at the same time have less money to lend to the people. This dries up investment and can inversely affect the GDP growth rate of the economy as well. Also, borrowing at a high rate means lending at a high rate. So interest on home loans, car loans, etc. goes up. This leads to a fall in consumption. But if there is too much money in the economy, then people will spend more and this can increase price levels. RBI has to deal with this dichotomy while deciding on whether to increase, decrease or leave the interest rates unchanged. The reduction in interest rate should ideally result in reduced lending rates and increased investments. However, looking at the past figures, the repo rate has been lowered by 175 basis points from 8% to 6.25% since January 2015, which hasn't translated into a decrease in lending rates. Vrinda Agarwal, WION, New Delhi.